Introduction. Private equity, often abbreviated as PE, is one of the most powerful forces in global finance. It refers to pools of capital raised by investment firms that buy companies, transform them, and eventually sell them at a profit. Unlike public markets, where companies are listed on stock exchanges and anyone can buy shares, private equity deals with ownership of private companies or takes public companies private. The philosophy is simple: buy, improve, and then sell. But behind this simple cycle lies a complex machinery of investors, fund structures, value creation strategies, and risks that make private equity both fascinating and controversial. How private equity works. The journey of a private equity investment typically begins with fundraising. A private equity firm, which acts as the manager, raises money from large institutional investors such as pension funds, insurance companies, sovereign wealth funds, endowments, and wealthy individuals. These investors are called limited partners, or LPs, because their liability is limited to the money they contribute. The private equity firm itself is called the general partner, or GP. The GP manages the fund, sources deals, and makes investment decisions. Once the fund is raised, the PE firm identifies potential target companies. These targets might be undervalued businesses, companies with growth potential, or even firms in distress. After acquiring a controlling or significant stake, the real work begins: value creation. This is the heart of private equity. Value can be created by improving operational efficiency, expanding into new markets, restructuring finances, or guiding management to make better strategic decisions. The PE firm typically holds onto an investment for 5 to 10 years. When the time is right, it exits the investment, either by selling the company to another business, selling it to another PE fund, or by taking it public through an initial public offering. The profits from the sale are then distributed back to the investors. Types of private equity investments. There are several forms of private equity investments. The most common is the leveraged buyout, or LBO, where a company is purchased using a mix of equity and a significant amount of debt. The idea is that by using debt, the equity investors can magnify their returns, though it comes with higher risk. Another form is growth capital, where PE firms take minority stakes in already successful businesses that need additional funds to expand further. Venture capital, often considered a subset of private equity, focuses on funding startups and early-stage companies that have high growth potential but are still risky. Then, there are distressed or turnaround investments, where PE firms buy struggling companies, restructure them, and attempt to revive profitability. Finally, some firms run what are called fund of funds, where the private equity vehicle invests not directly in companies, but in other private equity funds to diversify risk. Structure of a private equity fund. A typical private equity fund has a lifespan of about 10 years. The first 5 to 7 years are the investment period, when the firm actively deploys capital into companies. The remaining years are the harvesting period, when exits are pursued and returns are realized. The compensation model in private equity is famously referred to as 2 and 20. The firm charges its investors a 2% annual management fee on the committed capital, regardless of performance. On top of that, the firm also takes 20% of the profits generated from successful exits. This is called carried interest. This structure heavily incentivizes the PE firm to deliver strong returns. How private equity creates value. The key to private equity success lies in value creation. One lever is operational efficiency. PE firms often cut unnecessary costs, streamline processes, and drive productivity. Another lever is revenue growth. This might mean launching new products, entering new markets, or acquiring smaller competitors to build scale. A third lever is financial engineering, where clever use of debt structures amplifies the returns on equity. And finally, governance plays a huge role. PE firms often install stronger boards, replace or incentivize management, and ensure that leadership has clear targets and accountability. Risks in private equity. While private equity has created immense wealth, it carries significant risks. One is illiquidity. Investors commit their money for 10 years or more, and they cannot easily withdraw it. Another is leverage risk. Because many deals are financed with debt, if the company underperforms, it can spiral into financial distress or even bankruptcy. Execution risk is also critical. Not every operational improvement plan works as intended. There's also valuation risk. If the firm overpays at entry, the exit multiples may never justify the investment. And of course, regulatory and political risks can impact deals, especially across multiple countries. Own metrics used in private equity. Performance in private equity is measured through specific metrics. The most common is IRR, or internal rate of return, which calculates the annualized return considering cash flows in and out of the investment. Another is MOIC, or multiple on invested capital, which is simply how many times the original money was multiplied. Debt to EBITDA is used to measure leverage. While cash-on-cash returns tell investors how much actual money has come back compared to what was invested. Global and Indian landscape. Globally, the biggest private equity players are names like Blackstone, KKR, Carlyle, Apollo, and Bain Capital. These firms manage hundreds of billions of dollars and operate across sectors and geographies. In India, private equity is a fast-growing segment, with firms such as ChrysCapital, True North, Kedara Capital, and Everstone Partners playing major roles alongside global giants like Blackstone and Peak 15, formerly Sequoia India. Popular sectors include technology, healthcare, financial services, consumer products, and infrastructure. Advantages of private equity. For companies, private equity brings access to large amounts of growth capital, expertise in strategy, and stronger governance frameworks. For investors, PE offers the potential for higher returns compared to public markets and provides portfolio diversification. Criticism of private equity. Yet, PE has its critics. Many argue that PE firms focus too much on short-term gains at the expense of long-term health, often cutting jobs and slashing costs to make companies look profitable for a quick exit. Because so much debt is involved, some acquired firms collapse under financial pressure. And because PE firms operate privately, transparency is limited compared to public companies. Real-world examples. The success stories are legendary. Blackstone's acquisition of Hilton Hotels in 2007 for $26 billion, followed by an IPO exit in 2013 valued at over $32 billion, generated one of the most profitable deals in history. But failures exist too. Toys R Us, acquired in a debt-laden buyout by KKR, Bain Capital, and Vornado, eventually went bankrupt in 2017. In India, one of the biggest success stories is Flipkart, which received early backing from venture capital and private equity investors, and was eventually acquired by Walmart in 2018 for $16 billion. Conclusion: private equity is not just about money. It is about vision, discipline, and execution. At its best, it can unlock hidden potential in companies, create jobs, and generate wealth for investors and economies. At its worst, it can burden companies with debt, destroy jobs, and prioritize profits over sustainability. The essence of private equity lies in 3 words: buy smart, improve fast, and exit well.